and listen to me very well. For us to be able to handle this advanced, capital budgeting, ladies and gentlemen, we need what we call discounting. We need what we call discounting techniques, because one of the ways that we'll be using to do this capital budgeting is net present valuation. So we have to do what we call discounting. What here? Discounting techniques mentioned there. Discounting techniques. Discounting techniques. Yeah. So under discounting techniques, ladies and gentlemen, what do I want us to do here? Under discounting techniques, I would want us to mention there that this is the process. This is the process of determining present values of cash flows. Process of determining present values of cash flows. Present values of who? Of cash flows. Full stop there. The process of determining the present values of cash flows is what we call discounting. Remember, these cash flows in the very future, they will be looking to be very big. But when you bring them back to today, when you do what we call a present valuation, we expect to get what we call smaller values. So perhaps in this case here, 1,000,000 shillings today could be worth like 900,000. That difference is what we call discount. So discounting is the process of determining present values of cash flows. Tell us that there are two types of cash flows. There are two types of cash flows. There are two types of cash flows. There are two types of who? Of cash flows. There are two types of cash flows. Which types are these? This we have to write, all of us. So we have what we call irregular cash flows. We have what we call irregular cash flows. Yeah, irregular cash flows. And then number two, we have what we call regular cash flows. These are also the ones you call annuities. These are the ones we call what here? Annuities. The ones we call annuities. So there are two types of cash flows. Number one, we have irregular. And then number two, we have what here? Regular. Now, what are we supposed to appreciate, ladies and gentlemen, about these two types of cash flows? What you're supposed to appreciate about these two types of cash flows is this, that anytime they want us to discount irregular cash flows, we shall always use what we call PVIF. Anytime they want us to get discounted cash flows, we shall always use what we are calling what here? PVIF to discount them. How about regular cash flows? Regular cash flows, we shall use what we call PVFA to discount them. Use PVFA. Are you able to remember what these things stand for? Ah, great. So in this case here, they are telling me, Mwalimu, this we can remember. Yeah, and the PVIF stands for what we call present value, interest, what here, somebody? Interest factor. That is PVIF, present value, interest factor. PVIF is present value, interest factor. How about PVIFA? PVIFA, ladies and gentlemen, everything in this case will remain the same. Present value, interest factor, but now this time round of what here, somebody? A stands for who? Annuity, yes. A stands for annuity. Present value, interest factor of an annuity. Present value, interest factor of an annuity. And they're telling me, Mwalimu, these ones here, acronyms, we understood what they meant fully. But what I don't know is whether they still remember the formulas. Are you able to remember the PV formula? Are they able to remember the PV formula? I hope the online guys are able to follow. Are they able to remember the PV formula? How do we get PVF? My good students, to get PVF, this is normally what we do to get PVF. To get PVF, you will simply take here 1 plus the discounting rate. 1 plus the discounting rate, and then you raise this to negative what here? Negative n. Remember, in high school, we were compounding. In high school, it used to be positive n. If you remember, amount equals principal into 1 plus r raised to power n. Mostly because in the future, we expect a big amount. But here we are doing present value. So we must be deducting there. So remember that these are stands for what here? Rate of return. It stands for rate of return, which basically is the cost of who? Which basically is the cost of capital. You see, to us as investors, it's a rate of return. I've given this company my money, so they're giving me a rate of return. But you see, to the company, it's a cost. It's a cost of capital. It's a cost of capital like that. N, of course, N is the number of years. N stands for number of what year? Number of years like that, or number of months. Basically, N is a period. A period. But in most of our cases here, N will be number of years. N will be number of years. So let's look at an example before we go to our past paper. We have an example, ladies and gentlemen, here. So example. So this example, we have, ladies and gentlemen, the year. So here we have 1, 2, 3. And then they have given us the cash flows. Cash flows. That's L. Cash flows. So year number 1, they have given us a cash flow of 20. Year number 2, a cash flow of 25. Year number 3, a cash flow of 36. A cash flow of 36. So these are cash flows. Yeah, karibu sana. Mkumbuka mwanaume. These are cash flows, all right? Now, these cash flows, what else have they given us down here? They have given us 2 things down here. Under the additional info, number 1, they have told me that the initial outlay equals 32. Initial outlay is 32. Initial outlay is 32. And then number 2, ladies and gentlemen, they have given me the COC. COC stands for what here? Cost of capital, yes. COC stands for cost of capital. So kisikia COC sio jogo. Cost of capital, which will be our R. So this R, they have given us here 10%. 10%. So then what do they want me to do? What is the requirement here? The requirement here, my good students, they want me to get the net present value. They want me to get the net present value. They want me to get the net present value. They want me to get the net present value. Please write in full, especially if this is your very first section in a financial management class. Write this in full. NPV stands for net present what year? Net present value. So how do I do this? You see, I can see the total value here. Total value will be 20 plus 25 plus 36. I would have comfortably done that if this was not finance that we are doing. In finance, a shilling today is not exactly equal to a shilling tomorrow. In finance, that is what we call time value of money. All right. So first of all, we have to look for that time valuation. We need to do discounting here. So I will need to come and create a column that I call what here, somebody? PVF. Why am I using PVF here and not PVFA? Why am I using PVF here and not PVFA? Cash flows are irregular. You can see these cash flows are fluctuating. They are fluctuating. You know, regular cash flows would mean that year 1, I get 20. Year 2, I get 20. Year 3, I get 20. All the years I get 20, 20, 20. Uniform cash flows. These ones are irregular. So you're right. They're irregular, and irregular cash flows, we can always use what we call PVF. And if it is PV, are you able to regurgitate the formula to remember the formula? It's very easy. It is 1 plus what here? Yeah, 1 plus r raised to negative who? Raised to negative n. So I would want to get PV for each of the years. We get PV for each of the years. So then the first one will be 1 plus r. Do we know what our r is? Our r is 10%. 10% is the same as 0. What here? 0.1, isn't it? So all this will be 1 plus 0.1. All this will be 1 plus 0.1. 1 plus r is ever constant. What will be different here is the number of periods here. So raised to, the first one, it will be raised to, the first one here, it will be raised to negative 1. That's supposed to be really a raised thing, eh? The second one here, 2, so raised to negative 2, raised to negative 3, like that. So then, ladies and gentlemen, all of us should be able to have our calculators on our palms like this, and then we compute 1.1. You say 1.1, 1.1, raised to negative 1, raised to negative 1. Then you give me an answer. You say 1.1. Everybody shall know raise. In my class, everybody shall not assume. Don't assume that later on you'll be able to do these things right. We have to do everything right now here. That's why we are here today. So 1.1 raised to negative 1. This is how raised function looks in most calculators, raised. So you press 1.1 raised to negative 1. It gives us 0.9091, right? Thank you so much. How about the same 1.1, but this time around raised to negative? They don't have calculators. We shall overcome. You can ask your neighbor to give you a calculator, yeah, because everybody shall know how to raise. Everybody shall know how to raise. My online students, I cannot really feel you. My online students in the chats area, I'm not able to see anyone amongst you giving me an answer. Remember, I always end up giving my students lots of presents, which reminds me I owe you. I will have to start with you today. I'll have to start with you now, actually. I normally give my students lots of presents, especially if they're able to really be proactive. I always encourage being proactive. Proactive is all about being active in class. The second one is supposed to be 0.8264, right? How about the third one? 7513. Now, ladies and gentlemen, having gotten these PVs, great, Charlton. Having gotten these PVs, now we shall automatically use them for purposes of discounting. And how do we do discounting? We normally take the cash flows times these PVs. Cash flows times PVs. So come and give me a column here where we capture now the discounted cash flows. Please write it in full. Where we capture what we call discounted cash flows. And discounted cash flows, this is what basically we call PV, which is our present value. PV. Discounted cash flows. Discounted cash flows. So the very first cash flow that I have is 20, which goes with this discounting factor of 1991. So simply multiply the two, give me an answer. Multiply the two, give me an answer. You multiply the two and give me an answer. And by the way, you can use your mobile phone. It has a very good calculator. That one I know. Even raising your mobile phone, yes, can easily raise. Can easily raise. If the students in this case who have gone on a strike on me, it is the online guys. Imagine they don't want to give me even this simple. I can see one chart. Thank you so much. Rachel, thank you so much. You're the first one to give me some number there. Now I'm looking for the discounted cash flows. How do we get discounted cash flows? You take the normal cash flows we are given times the PV. How good will I feel when I realize my online students are able to participate? I will really be very happy. I will really be very, very happy. So in this case, ladies and gentlemen, cash flow 20 times 0.9091, which will give us what figure? 18.1? 0.182, I'm told. Thank you so much. How about the second cash flow, but discounted? 20.66. Thank you so much. The third cash flow is 36 multiplied by 0.7513, which will end up giving us 27.047. Thank you so much. Now that we have been able to bring these future cash flows to today's value, to today's terms, now they can be added. Now they are compatible for purposes of addition. So please go ahead and give me the total. Go ahead and give me the total present value. Do you have it? Go ahead. I can see charts here. I'm really, really excited. I can see charts here. So according to Rachel, and there is a student I've seen now, I'm safe. There's a student called Mary Wambui. Once this lady is here, even Rachel, I'm safe. I'll be able to get all the numbers. I don't need to carry any calculator. Now, these ones plus my students who are with me here physically, I'm sorted out. Big time. Big time. So I have the total present value. Yeah. Once I get the total present value, how do I change it to net present value? We less the initial outlay. You less the initial outlay. So come here, my good students, and subtract the initial outlay. Subtract the initial outlay. Subtract the initial outlay. So come here and get to subtract the initial outlay. So less initial outlay. Less initial. No. I can do better. Less initial outlay. Less initial outlay, which was given to us as 32, right? Which then at the end of the day, as this lady is giving me, the final answer is supposed to be 33 point. What name are we going to give to this beautiful number? Net present value. It is net of the initial outlay. So I shall call this one the net present value. Do you know when this net present value is positive, what kind of advice should we be able to give? The project is viable. The project is viable because it has a positive net present value. This project is viable. When it is viable, because it has got a positive net present value, basically that means that it shall be able to increase the shareholders' wealth. Shall be able to increase the shareholders' wealth like that. I hope they have been able to follow. I hope they have been able to follow. So net present value is what we wanted, and we've even been able to go to the next level, a notch higher, calculate NPV and interpret it. So I don't know whether we are together, especially the online guys. Have you been able to follow? I can see charts here. The online ninjas, are we really together? Accept the project sees it is viable. I love that. Yes. Thank you so much, Mary Wamboi. Great. Thank you so much. Now, ladies and gentlemen, from there, we look at what we call the regular cash flows. We look at what we call regular cash flows. So regular cash flows, we said, we are going to discount them using which criteria? PVFA, present value interest factor of what year? An annuity. PVFA, like this. Present value interest factor of who? Of an annuity. Abracadabra, would you kindly remind me anytime they want me to get the formula for PVFA for them, I will first of all remind myself the PV formula. Without getting tired, ladies and gentlemen, how do we get PV? The one that you have just done up there. It is 1 plus R raised to negative what here? You give me this anytime, I'll be able to get the PV formula for you anytime. The moment you give me this formula, get PV, this is normally what we do for PV. We take 1 minus the PV's formula. So 1 minus 1 plus R raised to negative what here, somebody? Negative N. Negative N. And then everything, including this one, to be divided by who? Somebody? R. Everything to be divided by R. Everything. Everything to be divided by R. Everything to be divided by R. That is what we do to get what we call PVFA, present value, interest factor of what here, somebody? An annuity. So with your permission, ladies and gentlemen, please listen and listen to me very well. We have in this case here, Mary Limited. Mary Limited expects to receive 50 into brackets million per annum, 50 million per annum for 7 years. For 7 years. For 7 years. She expects to get 50 million per annum for 7 years. For 7 years. Now, ladies and gentlemen, we are given cost of capital as 10%. We are required to simply get the total present value. We are required to get the total present value. So we have a company known as Meru Limited. It has been able to do some business. It will be getting 50 million at the end of each year. It's a normal cash flow. It's a normal cash flow. 50 million per annum. So meaning year 150, year 250, year 3, I can see uniformity. I can see an annuity. And she's going to receive these for a cool 7 years. And the cost of capital is 10% required. They want us to give them the total present value. This is really easy. I'm 100% sure that all of us shall be able to really handle this. All of us can handle this very well. I mean, I'm just doing it because I simply feel like doing it. Otherwise, I would have left you to do it. So how do we get this total present value? Get this total present value, this is what I will do. To get the total present value, I will take the 50 given. Please allow ourselves to omit the millions. And then I simply multiply these with what we call PVFA. PVFA, how many years? With what percentage? 10%. 7, 10%. 7,10%. PVFA, 7 years, 10%. So I only take one figure, 50. I multiply it with PVFA for 7 years at 10%, like that. And you're the ones who have told me in a few minutes ago, you told me that, Mwalimu, you know what? To get PVFA, take 1 minus into bracket 1 plus R raised to negative N, and then everything to be divided by who? R. So now I have everything really. So then my PVFA here will be 1. 1 plus, the R is the rate of return. It is the cost of capital. It is the COC. COC is 10%. So plus 0.1 there. And then we raise this to negative N, which is 7. Then everything to be divided by R, which again is 0.1. Everything to be divided by R, which is 0.1. 0.1. So then we have there 1 minus 1.1 raised to negative 7. You say equals. Whatever answer we get, we come and divide this by 0.1. I wish everybody had a calculator because I know so many guys fail to get these small concepts at the very beginning of the session, at the very beginning of the training. So it is 1 minus into brackets 1.1 raised to negative 7. Yeah. Then whatever we get there by saying equals, we shall be able to come and divide by 0.2, 0.1. Well, ladies and gentlemen, I can see my online students are already giving me an answer. They are telling me, Mwalimu, don't struggle a lot with this. That's Rachel. She's telling me, Mwalimu, PVFA here is supposed to be 4 point something. PVFA here is supposed to be 4.2. 868. No, 4.84. Thank you so much. I hope everybody is able to get that figure. And therefore, ladies and gentlemen, therefore, our total present value will be that 50. I'm simply reverting back to this times 4.868 A to 4 like that. So once I'm able to know that these are annuities, then I'll be able to know what to do pretty fast. So 50 times this will end up giving us what figure, ladies and gentlemen? 243.42. Remember, you can make a decision using total present value. We make normally decisions using net present value, which was not one of the requirements here. Here, the examiner wanted us to give them what we are calling the total present value. Ladies and gentlemen, then we can go straight away to our notes, advanced capital budgeting decisions. Remember, we had already introduced most of these things. Now we are looking at, including this risk and uncertainty. This we had already done. So what am I looking at? This thing is not moving the way I would want it to move. So this is what we are doing today. So today, ladies and gentlemen, we are looking at basic techniques. No. So today, what I'm looking at, my good students, is this. Here. Advanced methods of handling risk in capital budgeting. So, and your syllabus wants us to look at sensitivity analysis. So sensitivity analysis, that is the first method which your examiner wants us to look at. So what is sensitivity? How sensitive is a project towards changes of certain variables? So definition, sensitivity analysis examines how changes in one key variable. So in this case, it will be changing these variables one at a time, e.g. sales volume, costs, discount, rate, affect the project's outcome, which for purpose of your exams will be net present what here? Net present value. So basically, ladies and gentlemen, whenever we talk of sensitivity analysis, we are looking at the effect on the net present value as these variables change, but one at a time. How sensitive is this net present value to changes of key variables? So we are reading again. Definition, ladies and gentlemen, here. This is really important. The sensitivity analysis examines how changes in one key variable affects the project's net present value. What is the major purpose of this sensitivity analysis? To identify those very sensitive variables, to identify critical variables that have the greatest impact on NPV, to identify critical variables that have the greatest impact on NPV. Advantages, it's very simple to calculate. It will be able to identify for us the key risk drivers. It will be able to identify for us the key risk drivers. It helps management focus on significant variables. In this case hereby, they'll be able to manage those variables that are material. So the key advantage, and you'll be able to see this in your past papers, sensitivity analysis is quite a simple model to use. It will help us to identify the key risky drivers. It will help management to focus on significant whatever variables, those material, those sensitive variables. Limitations, it considers one variable at a time, which is a big limitation. We know, ladies and gentlemen, outside here, these variables will always change simultaneously. So if you look at, for example, the government today, you're being fought by so many things at the same time. People here on this side, we have brains, we have in this case here, oil prices. So most of these variables will really change simultaneously. But here we are saying that now the sensitivity analysis vary them one at a time. Does not provide any probability probability. So under sensitivity analysis, it will be very hard for you to get those expected monetary values. So we have, ladies and gentlemen, an example here from your past papers, November 2015. Question number 1B will be, you are expected here to download the past papers. They are always nowadays online. So November 2015, question number 1B, that is the first question we are doing here live with you. After this, we shall be able to go out there for Maghrib Muslim prayers. They are very, very important. All right, so November 2015, question number 1B, are we there? You don't have to copy the question because already you have it, right? So we are told here, a company is considering whether to purchase equipment to increase its production and sales what here? Volumes. So we want to bring an equipment so that we can become more efficient to see our volumes going up. The equipment cost is 500 million. So meaning that we already have the initial outlay. And has a useful life of how many years? 3 years, after which it can be sold as a scrap for 80 million. I would have been tempted very fast to calculate depreciation. Yeah, especially using a straight line method. But you see, in finance, if you go to a question which doesn't have a tax rate, if there is no tax, depreciation is irrelevant. You'll never calculate it. No tax, no depreciation. If you calculate it, it will be useless. So whenever you're not given tax, like in this entire question, a tax rate has not been provided totally. So automatically, ladies and gentlemen, we shall not bother calculating depreciation. For each of the 3 years of usage, the equipment is expected to increase sales revenue and operating costs by 600 million and 390 million respectively. So for each year, please listen, each year, our revenues are going up by 600 million. And our costs are also going up by what, somebody? How do we normally get profit? To get profit, we normally take revenue minus who? Cost. So then to get an incremental profit every year, I can see this machine on coming on board, I'll be able to get 600. My figures are in millions. I'll be able to get 600 with a cost of how much here, somebody? 390, which will end up giving me 200 and what here, somebody? So every year I'll be getting 210 as profit. Now remember, this question does not have any tax, so no depreciation. So automatically, this will be my cash flow. This will be my cash flow. And are you able to see that this cash flow will be uniform? Yeah, because they have said here, annual. They have said here increase sales revenue and operating cost by that. There's a place they told us for each of the 3 years. So it means that whatever you have there is per annum. I would want to give you a story. Let me give you a story. I love stories a lot. Stories normally, they make these guys to understand these things better. Let me bring this home. Now, my good students, if you are given here profit before depreciation and tax as 10, and then you are given depreciation as what here, for example, 3. And then you are told here that tax is what here, somebody? 0. Could you kindly give me the cash flow? Because you see, in finance, we don't discount profits. In finance, we normally discount cash flows. How do we get cash flow here? With your permission. With your permission. To get cash flow, this is what I shall do. This is what I shall do. I will take profit before depreciation and tax of 10. Then I take away what here? Depreciation, yes, of 3. So we get what, somebody there? 7. All right. So of course, this will be profit before who? Before tax, because now depreciation has already gone below the river, below the bridge. So once we get this PBT, what do? We share with the taxman. Taxman gets a share here. So we come and give this to the taxman. So less tax. What is our tax value? The taxman is not interested with our figures. So tax is 0. So, ladies and gentlemen, in this case here, I less 0 from 7. So that's 7. So then I have my profit after who? Once we have profit after tax, how do we change this to cash flow? We add back depreciation, yes. Add back depreciation. Add back depreciation. Over how much? 3. Which will end up giving me what here, somebody? Are you familiar with this 10? Do you know what that 10 is? It was our profit. So you see, once you get profit, and then the examiner tells you that there's no tax, or it doesn't even give you a rate of tax straight away, the profit you have is your cash flow. If I were you, I would have written this as an example at the back of my books. Oh, yes. This is very, very important here. I would have written this down as an example at the back of my books. So this example, it's PBDT 10, depreciation is 3, tax rate is 0, and then they want you to give them the cash flow, and then you take this as your solution. You take this as your solution, like that. So meaning that even the depreciation given there is irrelevant. Why is it irrelevant? Because tax is 0. Whenever tax is not provided, I shall not calculate depreciation. And even if it is given, it becomes what here? Irrelevant. Even if it is given, it becomes very, very irrelevant. It becomes very, very irrelevant. So wanafunzi wa online, once you finish, give me a signal. Show me some smoke, white smoke. By writing there Y for yes. Y for yes. So remember this 10, please, is my cash flow. So meaning that this is my cash flow. So meaning that whenever tax is not given, the profit you have at hand becomes your cash flow. The profit you have at hand becomes your cash flow. The profit you have at hand becomes your cash flow. Boy, I'm waiting for a signal from my online students. I can see now 6 of them. They are telling me, yes, thank you so much. And I'm so happy because I can see now they are 30. Ladies and gentlemen, this is not the method I would expect you to be using to get cash flow. This is a lengthy method for ATD students. For this advanced level, this is what we shall be doing. This is for ATD students. At this advanced level, method 2, this is what we shall be doing. Method 2. Method 2. So this method 2, you will simply take this profit before depreciation and what here somebody? Tax. Which is what here somebody? 10. And then what you will do immediately here is to come and less what we call what here? No, don't subtract depreciation, never. You less tax directly. On this figure, you less taxation. You less tax. It would be 30% of this, but now here we know it is 0. It is 0. So once in this case here you have less tax, remember, you never did any depreciation adjustment. You never subtracted depreciation. Now then you need to come and add what we call a depreciation tax shield. You add a depreciation tax shield, which will be 0% times depreciation itself, times depreciation, which is 3. It's called depreciation tax shield. Depreciation tax shield. You take the rate of tax times depreciation. So 0 times 3 will again end up giving me what here, somebody? 0. So remember, tax is to be deducted. This one is being added. So whatever we get here is what we shall be calling who? Cash flow. Which gives us what there, somebody? Which gives us 10. This is the approach that I'm giving green light, that approach. When I'm marking your books, and then I realize, ladies and gentlemen, in this case here, you have this method. I will not deal with a script of a very bright student. No, this one here, this is quite long, useless method, very useless method. Thank you so much. Now let's get back to our question. The question that we're doing, they want us to give them the percentage what? Change. Percentage change is what we call SA. What does SA stand for in this case? South Africa? Sensitivity analysis. So whenever you hear of percentage change, they want you to get sensitivity analysis metrics. Compute the percentage change required in each of the following factors for the project to be rejected. The first one is the initial cost of the equipment. The second one is the scrap value. And then the third one is what they're calling the sales what year? Revenue. So we start with the first one, which is what year? Sensitivity analysis of the initial cost of the equipment. All right. We break now. 6:50. Yeah, we take a break. And I hope all of us will be coming back because this lesson is so vital. Very important, yes. Thank you so much. All right, so pause recording for your revision in the future. Yeah, so the very first thing you're supposed to do whenever you see an examiner telling you to carry out sensitivity analysis, you should always go ahead and compute net present value of the project. So compute NPV of the project, abracadabra. Compute NPV of the project. Compute NPV of the project. So compute NPV of the project. I want to give you 3 minutes now that I've already given you every cash flow. Yeah, please use the cash flows given for you to be able to give me the net present value of this project. Try your best. Let me share the question. This is the question. You have everything. You even have the cost of capital. You have the initial outlay. I believe you'll be able to give me the NPV. Just try, scribble something. Even if you don't get it, so what? 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 So long as you try. Identify your cash flows. I think if I leave you to do the question, I'll be quite unfair because this is the first past paper question you are doing in a class. So I should attempt the question first, right? That sentence means that you want to do the question. Let me do it. So then my NPV, I'm seeing 3 types of cash flows. 3 types of cash flows. There is, in this case here, the operational cash flows every year. The operational cash flow there will be 210. And because this is coming every year, so I have to multiply this with what here, somebody? PV. Is there any other cash flow you guys are able to see? There are 3 of them. Second one, the cost of the equipment, which is the initial cost. That will come. There is another cash flow. There is another cash flow that I'm seeing. You guys are finance scholars. Project is terminating. What happens? You sell, isn't it? You realize what we call scrap value. So scrap value, will scrap value be an annuity? Scrap value is only realized once at the end of the project. So it's a PV. No. You multiply this with the PV. Yeah, you multiply that with the PV. And then at the end of the day, as the brother told us, there's an initial outlay, which is a cash outflow. So I'm subtracting minus the initial outlay. Minus the initial outlay, like that. So can I ask you a question? Why are we not discounting the initial outlay? It's in a card today. It's a present value already. Initial outlay is in a card today. Thank you so much. Initial outlay is in a card today. Let me go back to the question. I read the question here. The equipment costs 500 million and has a useful life of 3 years, after which it can be sold as a scrap of how much here, somebody? 80. My figures are in thousands. So basically, my net present value here will be the 210 times PVFA, yeah, plus that scrap, which is what here? 80, times who? PVF, minus the initial outlay, which is what here? 100. In your own language, why am I multiplying this scrap value with PVF and not PVFA? Because we can only use PVFA for a repetitive figure. A figure which is repeating itself. This scrap will only be realized only once over the entire life. Yeah. So then let's see whether their students will be able to calculate for us the PVF. You see, they have told us 10%. And this is a project over how many years? 3 years. They told us somewhere 3 years. So let me see whether you great people now can apply the formula. Let me see whether you great people can apply the very formula. Are we doing advanced MA? Some people here? Advanced management accounting? You never came for the last class. All right. Please ensure that in the next class, we shall be there. I never miss my classes. Never. Never, never. Especially after results are out. So PVF, they're telling me, Mwalimu, the formula, this one we know. It is 1 plus who? R raised to negative n. So it will be 1 plus, the R is 10% raised to negative 3, which I can see the online ninjas are giving me an answer already. They're telling me it is 0.75, 13. Thanks, Achola. It's lump sum here. 0.75, 13. 0.75, 13. Is that correct? 1.1 raised to negative 3 point equals sawa 7513. Great. And then now, ladies and gentlemen, we want in this case here to calculate the PVFA for this PVFA here. So on the PVFA, I don't have to belabor. So I will be able to come here and say PVFA formula. I know the PVFA formula very easily. It will be 1 minus the PVF, 1 plus R raised to negative n. And then everything I divide by what here, somebody? R. So I want you to plug in the needed numbers and they give me the final answer. Plug them in. Plug them in. We know what our R is. We know what our N is. What has happened? We are here. Thank you so much. So these ninjas are giving me 0 point. It can't be 0 point. 2.48. Are you sure? Let me see whether my online ninjas are getting the same. Yes. 2.486. What here? 69. And I can easily plug in the numbers for all of us to really see whether we are on the same page. Because if there is anything I like the students I had here last semester, when I get like the entire class passing, it really becomes very, very good for me. The entire class should be able to pass. So to get this PVFA, we are saying it is 1 minus 1 plus R, which is 0.1, raised to negative 3, and then I divide everything by 0.1. I so believe that if you do it that way, you shall be able to get that number. And therefore, our net present value will be equal to, we have our annuity cash flow of 200 and what here, somebody? 10 times the PVFA that you got here, 2.4869, plus the scrap value of 80 times 0.7513 minus the initial outlay, which was 500. Initial outlay was 500 minus the initial outlay of 500. And then I can see Mary Achola has already given us an answer. Mary has already given us an answer. She's saying here, actually it's Mary, we have Pauline, Rachel, it is 82 point what here, somebody? 82.335 like that. Even if you are not asked, whenever you get a positive NPV, always remember for a free mark to tell us that the project is what? The project is viable. Always remember that. The project is viable. Always remember that. The project is viable. The project is viable. The project is viable. The project is viable. All of us, are we in agreement with this figure? Thank you so much. Please always remember, if you want to pass this paper one time, ensure that you are able to give answers in class. Be proactive. Even when you are not able to give an answer, you just stand up and shout 0. And then, of course, they will say, no, it's not 0. They give us the correct answer. At the end of the day, you have participated and your memory is now telling you that your mind is telling you that now, hey, I'm ready to understand this concept. What I mean is that we shall always be very proactive. Proactive. Kama klasi ya la semester ya management accounting. Si mlikuwa hatari sana. Yeah. Walikuwa wanaongea sana. All right. So now, ladies and gentlemen, having gotten this concept, we should be able to go back here to the question. So the question, they want us to give them sensitivity analysis with respect to the following factors. And remember, for sensitivity analysis, it is one factor at a time. So we start with the first factor, which is what? Your initial cost. So then you come and write here, sensitivity analysis percentage of initial cost. So this one, the formula is very easy. You will take the net present value. You take the net present value you have obtained there, divided by the present value of the factor, divided by present value of initial cost. So the factor always becomes the base. The factor always is the base. So you take the net present value divided by present value of the initial cost. And then, of course, whatever you shall get shall be multiplied by what year? Shall be multiplied by shall be multiplied by 100. Whatever you get there shall be multiplied by 100. Shall be multiplied by 100. So I would want you guys to tell me, what is the initial cost in this question? 500. What is the present value of that initial cost? 82. Present value of the initial cost. It is still 500. Because the initial cost were the guys who told me that the initial cost is in the card. That is never discounted. That is never discounted. Never discounted. So therefore, the sensitivity analysis of this initial cost will be NPV we got was 82.353 divided by present value of the initial cost, which is 500, times what here, somebody? 100. Times 100. Let me see what my online students are telling me. My online students are telling me, 500. Yeah, they are already getting this. They are getting this as 16 point what here? 47. So it means that the net present value is 16.47% sensitive as regards to the initial cost. Meaning that the initial cost, there is that room, breathing space, all the way up to 16.47. The initial cost can change, can increase by 16.47%, before the project becomes a loss-making project. If the initial cost, it increases by more than 16.47% more than, automatically now the project becomes unviable. The project now will post a negative NPV. So you can see this is quite a good factor because it's got a big allowance of change. Nobody will tell you to interpret. The most important thing is for us to know how to calculate this. And if you look at the answer provided, and these notes have got answers, Yeah, they've got answers here. So you can see, ladies and gentlemen, here we have, if you're able to see, let me just share this so that the physical student, not physical, but online, can see very well. Can see very well. Now, if you look at this, ladies and gentlemen, very well, this is what we have there. Yeah. So you can see here, we have a sensitivity of the initial cost. It's the NPV over the initial cost, which gave us 16.47%. So the initial cost could rise by about this before the project is done. What here somebody rejected. It could rise, go up by that 16.47 before the project is rejected. Now, my greatest of students here, I want you to go ahead and give us the sensitivity analysis of the second factor, which is scrap value now. Sensitivity analysis of scrap value. Let's see who will be able to get this correctly. The first student will be able to pin this down. Sensitivity analysis of scrap value. Sensitivity analysis of who? Scrap value. Sensitivity analysis of scrap value. This is the second requirement. This is the second requirement. The online people are already getting answers. The online students are already getting answers. They are telling me, Mwalimu, you know what? This one is supposed to be 137.02%. 137.02%. Do you know how these ninjas have done this question? Do you know how these ninjas have done this question? Do you know how they have done this question? Do you know how these ninjas have done this question? Just write something, write something, write something. We shall write something. So because to get the sensitivity analysis percentage of scrap value, we normally take NPV over the present value of the factor. Present value of the scrap. Whatever answer we get, we shall multiply with 100. Whatever answer we get, we shall multiply with 100. So what is the NPV? It is 82 point what? 353. Do you know the scrap value? It is 80. But you see, this 80 is in the future. So I need to come and multiply this with the PV. 3 years, 10%. And unfortunately, I will not be looking for PV for fresh. I already have it. In the formula, I used it. In the formula, I used it. In the formula, actually, I have this. I have it. In the formula, this is what I should be picking. In the formula, this is what I should be. That is the present value of the scrap. Yes. Present value of the scrap. I'm not going to choose anything there again. No. So come here. It will be, ladies and gentlemen, come here. So it will be 82.353 divided by 80 times PV, which is 0.7513, like that. And then whatever we shall get, we multiply this with 100. Whatever we shall get, we multiply this by 100. So are we able to get that? Is it 150 something? 137.02%. Thank you so much. 137.02%. 137.02%. This is not a sensitive factor at all. Look at the allowance it has. That allowance is too big. You can change by the whole world without this NPV being affected there. So this is quite an insensitive, not sensitive at all. The lower the percentage, the higher the sensitivity. All right. And then now we go to the very last one. From the question paper, what they want us to do, the very last one, they want us to give them sensitivity analysis of what here? sales revenue. This one I would want to try it. I would want you to try this. So this is really yours. This is really yours. Sensitivity analysis of sales revenue. So sales revenue is the base. Sales revenue is the base. NPV must always be at the top. For the number of years I've marked these CASNEB exams, I'll always get somebody taking NPV at the bottom. NPV is always at the very top, always. Is the numerator. Is the numerator. So I'll give you exactly 1 minute. You try getting this. You try getting this. You try getting this. Try getting this. Try getting this. Somebody already has an answer. Imagine. 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 Imagine somebody already has an answer. It is 5.5 what here? 2. 5.52? 5.52 or 5.51 something, right? 5.5, 2. $5.52. So my good, very good students, please listen and listen to me very well. Listen and listen to me very well. We have here sensitivity analysis percentage of sales revenue. So this will be NPV over sales revenue. But it is not lost on me that this must always be present valued. The one at the base must always be present valued. So the NPV remains at 82.35. The sales revenue, is there somebody who is able to remember that our sales was 600? But this needs a discounting factor. And then remember that sales revenue was accruing to us every year. So this will be multiplied with what here, PV? PV for that we have in the question. Yeah. This shall be multiplied with the PV for that we have in the question. So this will be 82.353 all over 600 times, was it 2 point something? 2.86? 2.48? Thank you so much. Don't forget to put these in brackets as you do your multiplications. So say 82.353 divided by open bracket 600 times that. Whatever answer you get, you say times 100. What are we able to get, ladies and gentlemen? We am alone. 5 point something. 5 points. 5.52. Do a summary for us. So come here and do a summary for us. So the summary, remember we had initial outlay. We had the scrap value. And then lastly, what do we have here, somebody? Sales revenue. Sales revenue. So give us the SA percentages. SA percentages. So initial outlay SA percentage ilikuwa ngapi oye? SA percentages 16.47%. How about scrap value? 37.02%. And then lastly, sales revenue, 5.52%. So go ahead and rank. Which one in this case here is the most sensitive? Yes, the one with the least percentage. The lower the sensitivity analysis percentage, in this case here, that particular factor will be the most sensitive one. So this takes number 1, this takes number 2, this takes number 3, like that. And I'm 100% sure that you guys, should they give us this kind of a question, you'll be able to get everything okay. You're able to get everything okay. You'll be able to get everything. Okay. Now, ladies and gentlemen, please allow our... No, you haven't yet finished. And let me also see what the online ninjas are saying. Thank you so much, Pauline. Thank you so much, Achola Mary Wamboi. Great job. Thank you so much. Thank you so much. Thank you so much. Thank you so much. And with your very permission, then I will be able to go to the second model. Yeah. Before I go to the second model, look at the conclusion. It is telling us here that the sales revenue is the most sensitive variable, because even a small fall of about 5.5% will make the project what year unviable. Your syllabus wants us to do the second model after sensitivity. They are calling it Monte Carlo simulation analysis. Monte Carlo simulation analysis. So what is simulation? Simulation, remember, ladies and gentlemen, basically is the imitation of reality. When you are simulating, you are always imitating what your reality. You're imitating real world. Let me ask you a question. If today you were to go to a good driving school, you go to a good driving school, will these people, teachers, take you to the road with a physical vehicle? No. First of all, they'll give you a dummy vehicle inside the classroom. You walk around. In this case, here, some dummy roundabout. So those are fictions which are being used for purpose of what you're learning. Just like, for example, doctors, what shall they do? When they are learning here at the University of Nairobi, these guys, medicine, what they will be doing, they will be operating on rats, cats, until they learn the system, isn't it? That's when they can come to a real human being. So simulation is imitations of what are reality. We are imitating real world. Yeah. So in this case here, very, very important purpose is to provide a distribution of project outcomes, not just single values. And we normally use these simulations for purposes of doing what here? Learning. And for you to understand what we are talking about, it will be very, very important, first of all, for Mwalimu to take you through what we call simulation. You're writing now this random number ranges. Simulation, random number ranges. Simulation, random number ranges. I shall be able to do a past paper question. Simulation, random number ranges. Simulation, random number ranges. So simulation, random number ranges, what do we have here? Simulation, random number ranges, I will straight away give you an exercise. So I want to start a business, but I don't know what the price would be, but I can guess. It could either be 50, 60, or 70 with the following probabilities. So we have here probability of 0.3, 0.5, and 0.2. Remember, the total probability must add up to 1. Now, given this variable, we are required to determine random number ranges. Random number ranges. Probs stands for probabilities. This is something you can do with your eyes closed. It's really easy. How do we get to do this? You'll come here and give us what we call cumulative what here? Probabilities. So cumulative probabilities, we have 0.3. You're adding them, isn't it? So you add 0.5, 0.3, you get 0.8. So 0.8 plus 0.2, which gives us what figure? Somebody here? You can't say 1. We have to be consistent with decimal places. So it becomes 1. What here? Somebody? 0. It becomes 1.0. So what is the first thing you do? In simulation random number ranging, first of all, you give us what we call cumulative probabilities. And then now you come and see the decimal places. You see the decimal places. So decimal places. Now please listen and get to listen to me very well. Please listen and get to listen to me very well. With these decimal places, when you have one DP, one decimal place, you shall have one digit. One decimal place, you shall have here one what here? One digit. Random numbers. So Mwalimu, what do you mean with this one digit? This is how your random numbers will look like. It will be 0 all the way to 9. One digit. 1, 1. 0. Number 0. All the way to the upper limit, which will be 9. For you to understand, what if we had two decimal places? Two decimal places, we use how many digits? 2 digits. How will these 2 digits look like? 0, 0 to what here, somebody? 0, 0 to and mbili, and so forth. So if there are to be 3 digits, we shall talk of 0, 0, 0. 9, 9. It doesn't make sense that much, I know. So determine random number ranges. Always work with the number of decimal places. One decimal place equals 1 digit, 0 to 9. 2 decimal places, 2 digits, 0, 0 to 99, like that. Now, my very good students, please listen and listen to me very well. Look at what I will do to be able to write these random number ranges here. To get these random number ranges here, all right, random number ranges here, see what I'm doing out of my cumulative probabilities. It has always to start from what here, somebody? 0. And then how do I get the upper limit? To get the upper limit, you read this number as if it's a whole number. So read it as if it is 3. And then I take away 1 to get the upper limit. So to get the upper limit, I will take 3 minus 1, which is what you had, somebody? 2. Please listen. How do I get the next class? Next class from the number line, it starts from the next number after 2. The next number after 2 is what? 3. Which will go to the upper limit. Are you able to guess the upper limit for this? 7, yes. You read this as if it's a whole number, 8. And then you take away 1. You take away 1. So I write here 7. Let's go to the next class. So if you're right, if you've been able to understand, would you kindly give me the next range for the next class? 8 to 9, yes. It will be 8 here. And then you read this one as if it's a whole number 10. 10 minus 1, that gives me what here, somebody? 9. And now you can see we have covered all the way from 0 to what here, somebody? 0 to 9, like that. Let me see what my online students are saying. Thank you so much. Thank you so much. Thank you so much. And then I will be able to even try you with another example. But first of all, recognize that this is number who? Number 1. That's example number 1. These ones will be given in an exam. The only thing you want to be given will be cumulatives and random number array. Those cannot be given. So then we go to number 2. We go to number 2. So number 2, I would want in this case here to start my business. This business of mine, ladies and gentlemen, I don't know what my rent will be. So let me call that the fixed cost. I don't know what it will be. It could either be 1 million, 2 million, 3 million, with the following probabilities. So we have 0.30, 0.50, and a 0.20, because at the end of the day, they must add up to 1.00. So we are required to provide random number ranges. Required random number ranges. Give us random number who? Ranges. Give us random number ranges. Give us random number ranges. Give us random number ranges. Give us a random number, ranges. Try. Even if you don't get, try. So what? So what? So what? Just try. Try. Just try. Just try. The very first thing that you ought to have done by now is the accumulations. Just accumulate, accumulate. And please try to talk in my class. I've taught this paper for the last how many years? 23 years. So many students pass, but what I know, if you're very, very quiet, itakuwa ngumu sana kwako. Ngumu sana. Na kama mwanafunzi angeongea atakuwa anaongea uongo utapita sana. So they come and give us. So they're telling me, mwalimu, first of all, the cumulative probability, we have 0.30. When you add these, we get 0.80, right? When we add this, we get 1.00. Those are the cumulative probabilities. So now out of this, don't tell me that you know what, mwalimu, this 0 is insignificant. No. For us in simulation, whenever they give us those zeros, it means automatically that their level of accuracy is 2 decimal places here. So they come now here and they give us our random number ranges like that. So is there somebody who has the first one? It has to be 00 because the bus to 00 to 29. Is it 20 or 29? 29 because you see this is 30. 30 minus 1. 30 minus 1 is 29. And you can see the online guys are also shining quite a lot. From there, ladies and gentlemen, we have what here, somebody? 32, 79, isn't it? 82 to 99. 80 to 99. 80. You can see these guys are really shining here. Shining as well. Thank you so much. And once I've understood this, then getting these other questions now correctly will be a very, very easy thing. You can see now what we have here. November 2016. November 2016, question number 1B, SKB Limited is considering a proposal to manufacture a new drug named Millennium. Named Millennium. So this is the only thing you copy down, right? Named Millennium. Named Millennium. The drug will be manufactured using a machine which will cost how much? 13 million. So the initial cost is 13 million. The cash flows and drug life relating to Millennium have been estimated as stochastic exogenous variables with the following distributions. Why do you think are they using this kind of tough terminologies? To scare you. Yeah. Because as an examiner, AFM examiner, as an AFM examiner, I would want in this case, if it is this girl who has come in this case here, an exam room in a high-heeled shoes, great makeup. If it is a sadist of an examiner, the kind of paper this lady will get, she can very easily walk home, carrying her shoes, isn't it? Without any makeup, And then to do that, you shall always try to use this kind of word terminal. Wanafunzi wanafika nyuma wanauliza, hiyo ilikuwa ni AFM ama ilikuwa ni home science? But you shall never be scared. All right? So variables with the following probability distributions. So we have 2 variables. We have annual after-tax cash flow. Then we have drug life in years. The minimum required rate of return from this investment is 16%. The company has approached you as a financial expert to perform an analysis of the above project required. Using the following random numbers, perform 10 simulation runs of the net present what year value. Very easy. This I will get all the marks. How do I get all the marks? How I shall get all the marks? First, we start by identifying the variables. And the first variable we have here is the cash flow, isn't it? So could you then kindly copy this information down first? The way it is. Copy it down the way it is. You copy down that information the way it is. The one that I've circled. Don't copy the other one, because we handle one variable at a time. We handle one variable variable at a time. We handle one variable at a time. And then, ladies and gentlemen, remember the class that I normally teach, we normally have up to 200 students. When I see 30 students, participants here, plus another 10 physically here, I'm a bit worried. We need more than 200 students in this very evening class, which runs from 6 p.m., 8 p.m., 6 p.m. to 8 p.m. Yeah, we need these great numbers. And we can only be able to get those great numbers if we get outside there and tell people, hey, AFM at RCM is the best. Don't cheat them. Of course, you have experienced. AFM at RCM is the best. And then they'll come in droves. Many of them. So please, Mary and everybody else, Pauline, I'm leaving you with that noble duty of marketing. Yeah. Like now I taught you guys the other day. Was it 80 or which level? Now I can see every time you're passing, now you are becoming wazee kama mimi. Very soon, OMA, yes. Now very soon, mtakuwa mnakaa kiti moja na mimi 𝐏𝐸𝐿, which is really the thing. Really, really good. Really good. Thank you so much. Ladies and gentlemen, thank you so much. They have been able to copy this down. And in this case here, having copied this down, what do you think in this case here is expected of us? Having copied this down, this is what I expected them to do. This is what I expected them to do as great ninjas. So the annual after-tax cash flows, we have the probabilities. So I expect you to come and give me cumulative. And then you give me random number ranges. I know that you shall be able to get. I know that you shall be able to get that. You shall be able to get that. Don't copy my figures. Nobody's copying my figures. I know you are tired. There is quite that tendency of you guys to copy my figures, but just do it yourselves. Go ahead and give me the cumulative probabilities. And then you give me the random number ranges. So cumulative probability, I would want to see everybody doing it. I know you are a little bit tired, but we are overcoming. And I would want to see everybody doing this. Everybody shall do this. So the moment you get your random number ranges correctly, without copying mine, mention there why for yes, for me to continue. Or one of mine is wrong, right? Because you see, these are the probabilities given cumulatively. This will be 0.02. You take 0.02, you add here, you get 0.05, add. You keep on adding. 0.05 plus 0.15, you get 0.20, like that. And then come here and give us random number ranges. Did you realize that these are two decimal places? So we talk of 002, 01. It can't be just one because we must be consistent with those digits. We must be consistent with the digits. Let me try to make this a little bit bigger so that my physical students do not strain. So that they don't get to strain. The online ninjas, as pertains, in this case here, the annual cash flows, are we really together? The online ninjas, have they been able to do this? Have they been able to do that? I can see their charts. I hope it is all of them. Thank you so much. Then we have the second variable. The second variable is known as who? Drag life. Do you remember drag life? And they've given us the probabilistic distribution of drag life. They've given us this probabilistic distribution. They'll always give you up to here. This will be given always. So it's upon you now to straight away know that the next thing will be for you to get cumulative probabilities and then the ranging aspect. the ranging aspect. How I wish I had a way of blocking this to allow you, first of all, to do this on your own. I wish I had a way. Alafu AFM inafaa kusomwa every day. Unamaliza class namna hii, ukifika nyumbani, please angalia, ama ukiamka kesho very early in the morning, check these things. Check these things. You shall check them. You shall check these things. You shall check them out. You shall check them out. You shall check these things always. Because as Mary Achola is telling us there, our objective is one term. Not in terms of national government politics, no. But for purpose of passing these exams. Remember now we have a new syllabus coming in 2027. Like him say, 𝐏𝐫𝐢𝐜𝐞𝐬. 2027, there is a major overhaul review of the syllabus. New subjects, crazy things. Staki wapate. Heri tusome mpaka saa 6 mpaka saa 7. Mimi staki new syllabus mpata. Nataka new syllabus ikija, mkue mnaelekea huko. Mkue mmebaki na ile post. They have a very good rule. Ukiwa utakuwa mmebaki na ile BD alone, watakuachilia ufanye BD alone. Yeah. Utakuwa mmebaki na hii matakataka ya AFM. Oh. Utapata shida. Utapata shida sana. That is why if I were you, if there is a semester to study hard, it is this semester. And of course, a semester that you should be able to choose your lecturers wisely, it is this semester. So have you guys been able to finish up to here? Yes? Great. Online ninjas are not talking to me. I can only see 2 charts. Thank you so much. And I do not endeavor to take any extra minute of your time. I would wish us to end it there when we meet in our next class, which will be when? Thursday. We should be able to finish this very question. There are students who will tell me, Mwalimu, now this kind of a question, please just send us a video. Yeah. And then we shall be able to watch it so that when we meet, you do something different. Yeah. I'll also be able to do the same. I'll send you a video so that you finish this question. When we meet, it shall be something different for all of us. Please post the handout here. I will not be able to post it today. Regarding 𝗏𝐵𝐺𝐻𝐵, my friend, great. I will not be able to post here today. Hiyo itakuwa namna gani? Next what year? Next lesson, when you guys are over 200. So please do the marketing for me. Otherwise, thank you very much. Have a lovely night. And 𝗏𝐵𝐺𝐻𝐵 akiwa hapo nikisema one time, anafurahi sana, right? Huyu lazima anafurahi sana. Ni one time ya kupita mtihani wewe. Sio one time ya national government. So for the very new students, is it Thursday or Friday? It is Thursday. For the 6 p.m. to 8 p.m., it is Thursday. If you want to join this particular class, our mobile number is 0793 555 000. 0793 555 000. Bye-bye. See you on Thursday. Yeah, you see, Wycliffe, we have 2 teachers of AFM. We have in this case here, the class which I run of 6 p.m. to 8 p.m. And then we have teacher David who takes the 8 p.m. to 10 p.m. 8 p.m. to 10 p.m. So you get to choose. You can even choose to attend both classes. You can choose to attend both classes. Choose one teacher. The choice is yours. Otherwise, bye and bye-bye. Yeah, the LMS has issues. We are working